Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to this Peak Prosperity Podcast. I am your host, Chris Martenson, and it is May 9th, 2017. Now, as you know, I've long advocated for physical gold and silver to be part of every investment portfolio. And as you know, at our website, Peak Prosperity, we have Dave Fairtex's Precious Metals daily market commentary and his weekly updates. Just a wonderful resource there for people who are interested in precious metals. Now, the reasons we advocate for precious metals, really too numerous to go into here, but they all have their headwaters in the fact that central banks are conducting the largest, most dangerous, and insane monetary experiments in all of human history, and everything flows from there. Now, today, we're going to talk about another way to invest in gold and silver, and that's through the mining shares. Now, we've got a lot of interest in this at the site, and so we're going to be talking today with a leading expert who is going to help us understand gold mining companies because she understands them inside and out. We're talking today with Dr. Leanne Baker. PhD, is an independent director of Agnico Eagle Mines Limited, is a consultant to and a board member of many metals and mining industry companies since 2002. She was the president and chief executive, she is a consultant to and a board member of many metals and mining companies since 2002, and she has been the president and chief executive officer of Sutter Gold Mining. That was from November 2011 to June 2013. Previously, Dr. Baker was employed by Solomon Smith Barney, where she was one of the top-ranked mining sector equity analysts in the United States. And Dr. Baker is a graduate of the Colorado School of Mines, holding both an MS and a PhD in mineral economics. So, Leanne, thank you so much for joining us today, and welcome to the program.
Thank you very much, Chris. It's a pleasure to be with you.
So let's start here from the outside in. Gold today is down again here on this particular day in May 9th of 2017. Gold and silver have both been getting hammered for a while in this last stretch of a number of weeks here. Why should people, in your mind, be holding or be interested in holding precious metals as part of their portfolio?
Well, as you alluded to in the introduction, Chris, I've been focused on the precious metals market for a long time, and I really got my experience on the equity side during a decade when there was seemingly zero interest in the metals as an investment. My first equity research piece was published in September '91. I just looked it up. I was laying out some bullish arguments then, but clearly it took a while for the reality of the market to catch up with the fundamentals that were slowly but steadily improving during that decade. So I have not only followed the companies, I've invested in gold. I think I bought my first gold coins in the mid-'90s, and have just kind of gone from there. So for all the reasons that you allude to in your many pieces, and that many of the experts that I follow do such a good job expounding on various websites, gold, I think, is a key part of most investors' portfolios. Certainly anyone who has a significant amount of money that they're trying to build for retirement and all of that. So at this point, I think you can look at gold as a trade. I've never really done that. I don't do a lot of in and out trading, just partly by the nature of my relationships with companies are long term, and so the shares I hold are long term. I've found that I'm not a very good short-term trader, so the investments that I make, I try to time the buy point well so that I don't feel too stressed out over the ins and outs of it. But as we look at the market today, gold has come down from the 2011 peak of $1,900, now down in the low thousands, and it looks to me like we're getting to a point technically where it either has to break a bit higher and start moving up again, or we may have another leg lower. And if we do have another leg lower, that would be an excellent entry point, in my view, for people who don't have the positions that they would like for the long term, or who want to make a trade.
Yeah, I'm not a very interested or active trader in gold, trying to get in and out. That's not ever been my personal focus. Of course, we do have our own precious metal commentary is about trying to find, if you are looking for times to get in, sometimes clearly are better than others. And this moment feels like a pretty good time, and particularly if somebody hasn't made the move and started to develop a position in gold and silver. Now, it's always a good time to have your initial position, of course, but if you're going to leg in, this doesn't feel like a terrible time. And I want to get to that because I'm thinking of that both, from a technical standpoint, seeing where the market is, but the reason I'm interested in talking with you today is from the fundamental standpoint. I just really excited to talk to you because what I see when I look into the market is trying to understand where the companies are and what it really costs them to develop their mines and ore qualities and yields and things like that, as well as the all-in cost of production. That's where I'd like to go, because my view, could be wrong, but my view, it's the same view I hold of the oil markets, which is you can't stay at or below the marginal cost of new production for very long before you really begin to eat into your future supplies. And of course, that has an impact. Now, with that said, do you have any comments about the general structure of the markets today? Because it's been a little bizarre to me, amongst others, before we get into the fundamentals, that we're seeing $250 billion a month flow in from the central banks. It's flowing into pretty much every asset class out there that you can find: real estate, bonds, stocks, but not commodities. Is there? Do you have a sort of an opinion about why that might be? Is that something that you focus on?
I guess I don't focus on it to the extent that I used to. Mm-hmm. The fact that oil looks like it could be entering a period of weakness here. Other commodities have been seeing weakness. That may be signaling that this central bank experiment is starting to waver in terms of success. But what I've also realized for myself after the whole 2007, 2008, I don't just want to say downturn, but devastation that we saw, is that it seems like it's becoming almost impossible to forecast timing or reasons why things are going to end and how they're going to end. So the way I think about it is just to try and be prepared as you can for any contingency. If something happens quickly, are you prepared for that? If it takes 10 years longer than you think it might take, can you hold out until, you don't want to put all your eggs in one basket. And I've always found my tendency tends to be somewhat early in these things. But, we know it's going to end. We don't know when, and we certainly don't know how.
Well, yeah, absolutely, of course. So I tend to be early to these things as well, as you know, as somebody who follows my work. I'd rather be early than late to many of these stories. And Of course, I have the luxury of having gotten into gold pretty heavily back in 2001 and 2 was my primary moments of purchasing. So, I have a luxury that's very different from somebody who maybe started getting interested in it late, particularly somebody who got interested between 2010, 11 when we, it just struck me as odd, as you know, that 2011, almost within a week of the Federal Reserve announcing QE3, the most extraordinary expansion of monetary policy ever, was the exact moment when many of the commodities topped out. Very bizarre behavior, but there it is. So let's start all the way from the outside. Let's imagine somebody has got a physical gold position. They're looking to gain some more exposure. They want to start getting involved in mining shares. How should they begin looking at this space?
Well, from my standpoint, I would start probably by focusing on a few of the long-standing fund managers. A number of these investors have very good track records and do a great job of providing investor commentary on a week-to-week or month-to-month basis. So looking at mutual funds like the Tocqueville Fund, or that's John Hathaway or Frank Holmes down in San Antonio. That's where I think investors who don't want to do the nitty-gritty of looking at individual companies should start. But if you're interested in the individual companies, then I would, you have to start with the publicly available information, and you can get pretty much everything you need from the reports that companies put out. They have to report their reserves. They have to report their cost structure. They report the grades of their reserve bases. And you can get into as much detail as you want, looking at whether they're mining lower grades, higher grades, and on and on and on. What I've found with many individual investors is that it turns out to be more work than they're probably willing to do. So the first thing is to realize what kind of an investor you are, and if you're not someone who wants to stay on top of all that information, then perhaps you're better off with a good mutual fund, because they hire people who do all that work for you. When I was an analyst, I really felt like I needed to see all of the operations of the mining companies that I followed, and at the time I only followed the large producing companies, so the Newmont, Barricks. At that time, Agnico Eagle was one of the smaller companies. It's since evolved into one of the strong mid-tier companies that you would compare, with a Newmont, Barrick, Goldcorp, some of the big ones. So it was relatively easy to make judgments about the quality of the ore deposits. Did management seem to have a good handle on the cost structure, and all that kind of stuff. I don't know how much more detail you want me to get into that, but I guess the focus, I would say, is that you need to focus on cash flow, just as you would for an oil company. You can get bogged down in all the details, but in the end, what you really want to see is whether these companies can generate operating cash flow that's meaningful, and even beyond that, can they get to the point where they generate free cash flow, which is what they generate after they've paid for all the capital that it takes to bring these mines into existence. And as a rule, there aren't a lot of gold companies that really get to the point where they can generate free cash flow, because you're always in a situation where you have to replace the reserves that you mine. Gold companies tend to have very short reserve lives compared to copper companies or nickel companies, all the base metal companies. Those deposits can sometimes go on for 100 years or certainly several decades, and there really aren't that many gold deposits that have that kind of extensive long lives. There are some. Certainly South Africa, we saw that. In Nevada, we've seen that. But there are many more gold mines that tend to have reserve lives of 10 years or less. So those are the companies that are always going to be scrambling to continue to replace and grow the reserve bases that they have.
Now, I do love the cash flow statements. It's been one of my major critiques of the shale business because the shale oil companies, sort of to make a metaphor here, maybe an analogy, I guess, they've got a situation where they own some acreage. There's sweeter spots and less sweet spots, which would be the equivalent of high grade and lesser grade ores, yields percentages. And they'll drill in, and these wells will cost a lot of money, a lot of capital, and they'll deplete principally within 3 years. So 85% depletion. So if you're looking at that as sort of like, well, there's a 3-year life, productive life for the well and then a tail, it's not hard to say that after a company's been operating in their core spot for 3 to 5 years, they ought to be generating positive free cash flows, particularly if they're not acquiring new property lease acreage. And my critique was noticing that these companies, even after they had been operating, were generating wildly negative free cash flows, meaning that whatever their revenues they were getting from operations, less what they had to plow back in capital expenditures for new wells, was ending up in negative territory, and they were covering the gap with financing activity. So they were taking on more debt, issuing more equity, all of that. To me, that's a mark of a company. I mean, could we, if we were somebody who wanted to just very simply started scanning through, is that a good place to start? Is like, say, if a company's been in operation for a certain amount of time and they're still deeply in the negative free cash flow territory, is that a good place to begin sort of drawing a line and saying, I'm going to look elsewhere?
Absolutely. And the other point, and I think it speaks to the shale companies as well, much of their growth came by issuing debt in addition to going, and getting equity from investors. And that can be a death knell right out of the gate. So in my mind, only the largest gold companies that have a reserve base that can support a debt structure should have debt. So if you're looking at a small company, and if for any reason they've acquired debt, and in that I often include hedging strategies. When I was following the companies, gold prices, a good year, it was if gold could get over $300 an ounce. And there was a great temptation for companies to hedge their gold production, but that I'm not interested in gold companies that want to do that, because the reason why you buy is because you're expecting that the price will go up over the life of the asset. So so I think you focus on the free cash flow potential and you focus on the balance sheet, and that's a great place to start.
Now, that hedging strategies, I was a pretty active investor in gold shares from about 2005 through to about 2009, 10, somewhere in that zone. And then I kind of lost my way for a while, because what I was noticing was that as the gold prices were going up, my share prices weren't following. And when I finally got sophisticated and dug in, I discovered there was a lot of dilution going on. A lot of new equity issuance was happening, and the cash flows weren't being managed well. And so that's when I started to get my own education, and I peeled back and I said, wait a minute. These companies, in many cases, the companies had hedged their forward production, which meant they had capped their upside for the rising gold price, which wasn't why I was invested in them. I wanted some of that leverage to show up in the results, and it wasn't. And so I think maybe this isn't fair, but I thought it was a poorly managed industry for a while, at least in the companies I was looking at, because They were just really playing a game of dilution that didn't feel right to me as an investor, so I backed off. A, was that a fair sort of a characterization of the time? And if so, B, has there been a sort of a change in strategy in the industry?
I think it's absolutely a fair assessment. And while I do think there are many companies that are well managed, and there are a few companies that are brilliantly managed, the vast majority of the companies continue not to be well managed, and it's partly because the management teams can be very strong from a technical standpoint. They may be very good at finding good prospects, and but getting the money to actually get the job done is always a challenge in this industry. And so in my mind, you can have the companies that provide the financing are the ones who dictate how the balance sheets end up looking, and it often isn't pretty. And what you also find is that when the price of the metals starts moving up, when you start getting a good run, then it's very easy for these companies to raise money in the market. And that is a temptation that most of them will not forego. And in retrospect, it usually turns out to be good. You need to take the money when it's available. But it's a big risk for shareholders, because if they have the money, it's probably going to end up being spent, and then you get a downturn in the price, and a lot of them end up being in trouble. So I've been expecting, we have seen, a fair amount of weeding out since 2011. A number of companies have gone bankrupt. They've been acquired. It's what happens, but believe me, if we get, the next big run up, you're probably going to see a number of new companies, and, the same old thing. It's I guess it's the lure of gold. People are willing to throw their money in when they start getting bullish without asking a lot of questions. So you need to be careful.
Well, it seems to be that way in every cycle, and the same thing happened in the shale business, of course. So, yes, it seems to be a perennial concern to make sure that you're still tracking the fundamentals. But to capsulate what you said here, in some way, there are companies out there now that are well run, that have managed the balance sheet well, that have good reserves, and are managing good free cash flows at current levels. Is that correct? All right.
Yeah.
And so that's really, if people sort of boiled it down and said, listen, that's what I'm going to look at here. I want to make sure they haven't hedged all their future production away. They've got good reserves, and they've got positive free cash flows here at these levels. These will be the companies that are going to be well positioned when the next run comes. Yes. And, I would say for the most part, the largest companies have learned those hard lessons, even the ones that had been big hedgers in the past or had made ill-fated large acquisitions at the wrong time. The managements that are in place now are for the most part singing the same tune and trying to follow the same strategies. Without I don't want to recommend any companies, but I honestly believe that Agnico Eagle, where I'm on the board and, fully admit that I'm totally conflicted here, but the management team has done an excellent job of managing both the downturn and trying to position to take advantage of the next upturn, and, just doing things in a smart way. And I think they've provided a template for a number of other companies who are
even larger ones who are following that template now.
Okay, so that fantastic information. I want to turn now to sort of a broader trend here, which is, one of the pieces that I cover a lot at Peak Prosperity is this idea of the humans have kind of sort of hit the limits in some way, shape, or form. So when I'm looking at the average reported ore grades, this would be expressed in some grams per ton or some other way, which basically says, hey, how much of the stuff we're going after is in a ton of the source rock that it's found in. When I'm looking at this for silver and for gold, what I'm noticing is over time is a pretty pronounced decline in the reported yields. Is this do I have accurate information? Let me start there.
Yeah, no, I would say that's accurate information. Obviously the earliest gold discoveries were high grade, what they call lode mines, the California Mother Lode, where the project I was involved in as CEO, those were high grade operations. Then over time, technology changed. Open pit mining became feasible and more common in the early 1900s, and then in the 1980s, the heap leaching technology became more widespread and available and tested, and discoveries of areas, like the Carlin Trend in Nevada just opened up that whole low-grade potential. So it's been possible to get lower and lower grades and still make money by putting in the right kind of milling process or heap leaching process, what have you. And I would say there's also been, certainly in the 2000s, there's been a tendency, it's been popular among many of the mid-tier and smaller companies to go after lower grade deposits. And my view is that it didn't always turn out that well. A number of those companies are the ones that had to spend a lot of money trying to build projects, and they just didn't make it. So those kinds of cycles, going after higher grade but smaller projects versus lower grade but larger projects, they seem to run in cycles. And I'm always a proponent, again, of cash flow, so I'd rather have a company that doesn't produce as many ounces, but they're very profitable ounces, than a company that's trying to become the next multi-million ounce producer.
But perhaps doing that right at the skinny edge of survivable margins?
Yes, and you're vulnerable to, to very small declines in the price at that point as well. So it's, in my mind, it just can be a dangerous way to go. The question is there more gold to be discovered that is high grade like we used to see many, many decades ago? And the answer to that question is probably no. But the fact is there are, there still is a lot of exploration potential around the world, but it can tend to be in newer, harsher environments or in countries where the political situation isn't conducive to allowing companies to actually make a profit on their discoveries. So I think a lot of the easy to find gold in politically less risky countries has been found, but there still will be people who are successful, and that's the nature of the beast. And you're hoping to either jump on the bandwagon with one of the early stage companies or be involved with a major company that will benefit because they'll know to make an astute acquisition at the right time.
Now, I've seen a bunch of charts kicking around. I haven't run the numbers myself, but that basically suggests that where we are at the current price for gold, which is hovering around the 1,200 mark as we speak, it's a little north of that at about 1,215 at the moment, but that the all-in cost of production seems to be somewhere right around that number for the industry as a whole. Is that accurate?
I haven't looked at the industry-wide numbers for a while. That very well could be. The companies I'm most involved in have, a significantly lower, something in the, $700-800 range all-in sustaining cost, which includes sustaining capital. But I will, I guess, inject a note of caution here that the industry seems to always be able to find some gold to produce just under or just over the current gold price. Uh-huh. So I know when gold prices fell down, even as low as $250 back in the early 90s and again in the late 90s, companies were able to bring the cost structure down because it usually happens at a time when energy prices are also low. Mm-hmm. There are people now saying gold or oil could fall to $30 and maybe even lower. So if gold were to fall below $1,000 an ounce, my guess would be that it would be at the same time as energy prices were lower. And the other thing that you need to focus on is that a number of these companies are producing gold in non-dollar countries, for example, in Canada. So if the gold price goes down, the cost structure will be reflected in the currency as well. And so there's kind of a natural hedge there for those companies that have that foreign currency exposure, non-dollar currency exposure. So it kind of seems to balance out. So, yeah, I think you can make the argument that because people are producing at $1,200, gold has to move above that, but it's turned out to be sort of a specious argument in my experience. If gold goes to $1,900, you can bet you're going to find people producing gold for $1,800.
Right.
They just will.
Yeah, and you made the point about oil, and of course, when I look at a very long-term chart of the price of gold and the price of oil, seems to be a very good correlation there. And do you have a sense of who's, is oil the dog and is gold the tail in this story, or why is that correlation so good?
I am not sure which is the tail wagging which dog. I'm sure, some cycles it's one and some cycles it could be the other. But that's just what my experience is that that's the way it seems to work. Mm-hmm.
Mm-hmm. Well, let's, some people hold the view that mining in general is very destructive, and I guess we've gotten the feedback before at the site that to buy gold shares is encouraging environmental destruction. My point is that all mining is environmentally destructive, and I guess a counter argument as well. But gold to put I guess Warren Buffett's aphorism on the table. It's a rock you dig out of the ground and you put back in a hole in the ground. All of that. So where is gold mining in terms of its environmental impact? How has that progressed over time, and how should we be looking at that now?
Well, I would, I guess anyone who focuses just on the fact that you have to dig a hole in the ground to get metals out, and this is true not just for gold, obviously, but for any natural resource. I think you just need to be honest in looking at your daily life and look at all the ways that you use copper if you turn on any kind of a motor or any kind of a light bulb. You use oil every time you get into your car. You've, had to mine many, many minerals just to build the car that you drive. So the reality is that metals and other resources make our life possible. The companies, in my opinion, do an excellent job of mitigating their impact on the environment in terms of how they do the processing, how they restore once the mine is depleted. And at the same time, I just think the benefits, if you go to some of these countries where there hasn't been much in the way of development, and see what a positive impact it can have on the lives of communities that otherwise wouldn't have a way of supporting themselves. You might take a less hostile view. But anyway, I'm a proponent of mining. I've been involved in this industry now, for well over 30 years, and I'm actually very proud of the record that it has in helping to support our way of life and leaving the world a better place.
Now, as we look forward across supply, the supply of gold, so this is something I've been tracking for a while. Obviously, mining adds a very small percentage each year to the total amount of gold that's above ground, and the above ground stocks are divided into monetary metals, which are held by central banks primarily, and then other classifications under that. Of course, there's been a very large flow of above ground surface gold from the west to the east, if I can include India and China as part of the east in this story. And it always felt to me like that those flows would have to someday either mitigate, or the West would have to just say, hey, we don't care about gold at this point in time, and all of that. So the amount of interest from other countries in gold as we look across the world at this point in time, from your perspective, is there a hemorrhaging of gold from the west to the east? Have you detected yourself at the mining level interest from other countries, from the east, saying that they want to have access to the flows, or how is this west to east thesis sort of landing with you?
Well, that has been part of my thesis ever since I started looking at the industry. So the reports that I wrote in the 90s were talking about that very issue. We've seen it with the slow declines in central bank holdings among Western central banks. We've seen, there's not a lot of mining of gold in countries like India. China is now the largest gold producer, but they still buy a lot of gold that flows in from outside. So, there's a cultural affinity for gold in many of the countries of Asia, particularly, and then the Indian subcontinent, as well as the Middle East. That's always been true, despite the fact that we occasionally hear stories about how that will change at some point. They'll all become westernized. We haven't seen that. They are much more of saving nations than certainly we are now in the United States, and the same is true, I think, for many other Western countries as well. So I think that's a trend that will continue. And when you really think about it, the numbers, when I was looking at them, you look at all the gold that's ever been produced, which, with a little bit of wastage there, most of that gold is still available in some way, shape, or form above ground. But all the gold that's produced is still not enough to provide 1 ounce of gold per person living in the world. So the people in that part of the world have more than their allocation based on the availability, and I think an awful lot of people in the West really have no interest whatsoever.
Yeah, as a friend of mine, Grant Williams, put it, nobody cares.
Nobody cares. Yeah, that's a great. That was just a great presentation he did.
Wasn't that? It was really perfect. Nobody cares, and of course, nobody cares until everybody cares, and then it shifts. And it's been a long time coming, and it feels to me more than ever that the powers that be have really got their hands on the levers really firmly at this stage, because it is astonishing to me that $250 billion a month is flowing into our financial markets, and almost none of that is flowing through the paper markets into commodities at this stage across the board. And as much as I think it's just bizarre in gold and silver, I mean, I'd be absolutely livid too if I was somebody in the oil business looking at what's happening, because it's clear that the financial markets that do control the physical pricing are very much in the hands of algorithms, big players, hot money, speculators, yada, yada. And so the question I have for you is, it's always been a little bit of a mystery to me, and maybe you sort of answered it by virtue of saying the companies that control the financing for the mining industry. But I remember hearing one CEO once of one silver company saying, "Hey, this is nuts. You know, our commodity that we produce, this silver that we produce, we've got 8 banks that are short essentially more than a half a year's worth of production. It's the largest short position and paper position of any commodity out there. It feels manipulative. Let's band together and withhold some of our product," or something like that. I mean, that was the idea. And boy, that idea just disappeared into the ether. Because I assume that's a bad idea if you need to raise more financing to be taking on those cast of characters. Is there, if you run into that there's, is there any grumbling in the boardrooms about what seems to be the participants who are mainly controlling the price of the product have just play with paper? They have nothing to do with it.
Yeah, I think the idea that was suggested of holding metal off, I'm sure the lawyers in those companies were very adamant that you do not want to talk about that because you'll run afoul of antitrust regulations in certainly in the U.S. However, there have been instances, and you may remember Rob McEwen when he was heading up Goldcorp. They did hold gold off, and I'm on the board of McEwen Mining now, and there was a time when the company held some of its liquidity in precious metals. So there are a few, I would say no more than a handful of CEOs who really appreciate that. Certainly people know about it, but the managements for the most part are just more focused on their operations, their exploration, than they are on, they know that once they sell the metal, it's sort of outside their control. So most of them are not, just not that interested or have the time or are savvy enough to try and fight that battle. They have enough battles trying to make a profit doing what they're doing. But your point is very well taken, and there are several CEOs who do agree with you.
Well, and again, I think the oil business could have a similar claim, and so could grains and a variety of other places like that. It's just the concentration of positions, though, in silver is rather extreme compared to any other commodity I follow. It's really off the charts, and for the CFTC under Chilton to have and Gensler to have sort of said, well, we looked at it, but maybe there's something going on, but we don't have the resources to really go after that. I'm like, what? What do you mean you don't have the resources to look into that? I thought that was your job to have those resources. That's your market, but their choice, how they want to run that. I guess
we all know about the revolving door.
Yeah, it's throwing a 30-mile-an-hour wind. It's revolving so fast.
Yes.
Yeah. So yes, we all understand. Yeah, we get that. So, well, in closing here, because we've run out of time, your summary then of where we are at this particular stage of the cycle, if I could characterize it, would be that we're closer to the end of this languishing downturn cycle than we are to the beginning. And when this ends and turns around, there will be some great opportunities in here. And this would be a reasonable time for people to begin accumulating their positions if they were of a mind to do so. Is that fair?
Yeah, no, that's absolutely fair in terms of the metal, and in terms of the shares, as I mentioned, if you really want to get involved in buying and selling the shares, now would be a good time to start doing your homework to figure out which fund do I want to buy or which companies do I want to buy when the price is right.
Well, fantastic. Thank you so much for your time today, Leanne. And if people were interested in following your work, is there any way for them to do that?
I don't really publish the way I used to, but I would say anyone who wants to get a hold of me can get my information from you or Adam Taggart. We live out in the same neck of the woods here, and I'm happy to talk to anyone or have an email exchange.
Well, fantastic. There will also be an opportunity maybe in the comment section under this podcast at the site at Peak Prosperity. Of course, we will.
I can do that.
We'll continue the conversation there. So, Leanne, thank you so much for your time today, and it's been a real pleasure.
Well, thank you for having me. I really appreciate it, and I love the work that you guys do.
Oh,